And the International Monetary Fund has warned that global output could be cut by 4% over the next 5 years by a repeat of the mistakes witnessed during the 2008-2009 recession. Now, the IMF used its half-yearly global financial stability report to call for the urgent action on the problems of banks in the Eurozone, noting that a third of them faced growing non-performing loans and weak business models. The fund also said that financial soundness could be eroded to an extent that growth and financial stability are affected. Now, findings from the report indicate that though banks in advanced economies had become safer in recent years, they came under market pressure at the start of the year. Now, Daniel Ringes is live in Washington, D.C. now with more on the spring meetings that are taking place this week. Daniel, welcome to the show. Now, this meeting started off with a cloud hanging over proceedings. Of course, yesterday the IMF downgraded its outlook for growth for most regions and, of course, for the global economy as a whole. What have been the bright spots, if any at all?
Well, I think you're right in your overall assessment that there is a lot of clouds. The main sort of assessment of the global economy is that the best case scenario is that it's going to be mediocre growth going forward. The worst case scenario is that we have all sorts of chops and volatility in the global markets, which could really undermine investor confidence going forward. So what do individual countries do in that context? That's the question that's being posed here at the International Monetary Fund and World Bank meetings. The answer they are positing is that the era of sort of money growing on trees has gone. And now there's a period where individual countries, policymakers have to begin to make a set of decisions which implement smarter policies for the future of their own countries and provide confidence to international markets, to investors, to continue to have confidence in those countries. And in order to do that, you have to implement a range of measures depending on your own circumstances, but it could include things like having better tax revenues so that you can invest more and finding ways to diversify your economy away from the commodity cycle boom that we've been experiencing. So there's a range of things that they want countries to do. The argument is, well, there's no silver bullet. It's going to take a very long time to bring this around. But if you start now, you're creating the next opportunity down the line to benefit from the next cycle of growth when it does occur. And you're providing some reassurance to investors who are willing to take that risk.
Well, Daniel, let's talk about Africa. And of course, today we saw an event on unlocking Africa's agricultural potential, attended by both Africa's private and public sector. What were some of the issues that came out of that event?
Well, it's certainly true that the agricultural sector in Africa is potentially one of the biggest ways in which investors can make a very healthy return. But there are barriers to that. Some of those include infrastructure, the ability of getting the food to market. They include technological barriers. Some of those can be overcome. Some of them are political barriers. And also, you know, there's a lot, as was pointed out, there's a lot of money swirling around in pension funds, particularly in Europe with the aging population and also here in the United States, that gets very tepid returns and has no prospect of doing particularly well. How do you get that money to go into African agriculture where you could potentially have much greater rates of return? So it's all about finding ways to bring the money in there, but also to find ways to eliminate the barriers, not only in terms of the infrastructure, the cold storage, the techniques, but also the ability to have intra-African trade and also create much more robust export markets, improved port infrastructure. All of those kind of things are being discussed here.
Now, Daniel, we do know that the event goes on till Sunday. What more can we expect going forward into the week? And of course, are Africa's financial sector and finance ministers visibly and aggressively representing the continent and advocating for issues that, of course, are in the interest for Africans?
Right, I think there has been a long period of time where the policymakers and of course the journalists have been so focused on the European picture with the crisis in Greece. Certainly there's some interest in the prospect of Britain going out of the euro and what that might mean for the European and global economy. But I think this time around, emerging market economies are definitely getting the biggest slice of the attention. Not least because I think the commodity cycle issue, the slowdown in China, is having a much more biting effect. And what they are seeking to do here is to try to find a route forward for those economies that is positive, but reflects the slower growth going forward. So you're going to have International Monetary Fund Managing Director Christine Lagarde, you're going to have the head of the World Bank all coming out to do their separate policy speeches. But all the lower down officials at the moment have set this stage for a rather gloomy picture. I think now, as we start to see African finance ministers come into this, they are going to have to take this agenda and run with it and find innovative ways to get over these barriers, and also to seek a more conciliatory atmosphere with international investors, with people here in Washington, about moving forward in a more cooperative way. I think that's fundamentally what these meetings are about. Finding ways in which you can have a win-win, and finding ways in which investors can find good places for their money and unlock the potential for Africa moving forward in a much more effective way.
That's right, Daniel. Well, thank you so much for that update. Daniel Wingers joining us in Washington, D.C.